What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday, everybody. I hope you're having a wonderful weekend. With perhaps the sole exception of Xi'an, which may very well soon stamp out their outbreak after almost a month of strict lockdown, the outbreak situation nationally in China is worsening every day, and if officials cannot get a handle on it in the next few days, the virus may well break out of control and wash across the world's most populous nation. As of the filming of this, new cases are being discovered in dozens of localities across the continent-sized country. Almost 20 million people are under strict lockdown, and 100 million under varying degrees of restrictions. We are going to once again look at the economic cost of Beijing's zero-tolerance policy, or dynamic clearing policy, as state media has started calling it, shortly. The concerning news from yesterday, Friday, of course, was the discovery of local cases in Shanghai, the beating heart of the Chinese economy. We covered that yesterday. It has been confirmed today that these official cases are indeed Omicron cases. Thus, this is the third major Omicron outbreak in less than a week in the People's Republic of China. The first started in the northern port city of Tianjin, the gateway to Beijing, the capital, last weekend. Since then, despite almost daily mass testing and a highly restricted environment, though not a full lockdown like we've seen in Xi'an, local Omicron cases have spread to the city of Anyang and surrounding counties in Henan province, as well as Dalian in the northeast. The second official Omicron outbreak is in the Pearl River Delta, an industrial and financial powerhouse on the same level of importance as the Yangtze River Delta. The Pearl River Delta is home to Shenzhen, to Guangzhou, also known as Canton in English, where we get the word Cantonese in English, as well as the special administrative regions of Macau and Hong Kong. This second Omicron outbreak, which was first discovered in Shenzhen only a few days ago, has already spread to Zhongshan and Zhuhai in the region. We also learned just a few hours ago that a new case has been discovered in Hunan as well. Hunan, famous, of course, for its spicy food, and it's also the birthplace of Chairman Mao Zedong. There isn't too much information on this case, so we can't give many details at this point, but it could represent a new outbreak epicenter if not brought under control quickly. With the third Omicron outbreak in the critically important city of Shanghai, it seems that the highly transmissible Omicron variant may simply be too difficult to keep out of the country. And also keep in mind, even though China's population is 87% vaccinated, mounting evidence suggests that China-made vaccines appear to provide inadequate protection against Omicron. This all, once again, forces Beijing's leadership to face the question, is the highly disruptive and expensive zero cases policy worth the cost? And if these outbreaks cannot be brought under control, is Beijing willing to order an economically devastating nationwide lockdown? As we discovered last week, Goldman Sachs noted in a January 5th report the economic costs of Beijing's COVID-0 stance, quote, appear to be increasing over time as each new variant is more transmissible than the previous ones, end quote. And a few days before that, Eurasia Group warned that China's zero cases policy is the biggest risk of 2022 in their view. In a separate report, Goldman Sachs also predicted conservatively that if a national lockdown was implemented for just a few weeks, even with strong post-lockdown stimulus, growth would plunge to just above 0%. But even without a national lockdown, the disruptions of sporadic outbreaks and lockdowns that we are seeing now has come at a high cost. Ningbo restrictions have hit one of the world's biggest ports. Closed borders in the south have smashed two-way trade with neighbors like Vietnam, and major international companies like Toyota and Samsung have had to suspend operations due to outbreaks in Tianjin and Xi'an respectively. And of course, Even if there was no pandemic, the fact remains that China is dealing with its housing crisis, which has the potential to be far more devastating than a national lockdown. Indeed, US investment bank JP Morgan in a research note this week observed, quote, "In the near term, the property market slowdown remains the biggest threat to macroeconomic and financial stability in China." End quote. Okay, next up, China has been facing a two-front war in its energy crisis. For months now, China has been scrambling to source enough coal to keep the country warm through the winter. This is something we've been following very closely since this crisis first started several months ago. And now with the situation in Kazakhstan and energy being cut from Uzbekistan, China has fresh energy concerns for oil and natural gas. In the face of these challenges, China has turned north to Russia. Two Chinese companies this week announced long-term liquefied natural gas (LNG) supply agreements with Russia's natural gas producer Novatek, taking 5.76 million tons of LNG from the company's Arctic LNG2 project, or 29% of exported capacity. Natural gas is incredibly important for China and its economy. China passed Japan last year to become the world's largest importer of liquefied natural gas, driven largely by a desire to move away from coal. China imported 81.4 million tons of the natural gas in 2021, up 17.5% from 2020. And last up, of course, we need to continue to closely follow the housing crisis, the Evergrande housing crisis in China. Quickly, if you're enjoying the episode, don't forget to hit the like button. It's the only way this video can be shown to new people. And if you're watching this for the first time, you're getting some value from the episode, maybe consider subscribing, hit that bell notification, and you'll have the most up-to-date analysis when I release these every day. Okay, let's move on. This week, China Evergrande Group's first electric vehicle, an SUV, rolled off the assembly line in what some commentators are calling an important step for the world's most indebted property developer. The model is priced at a competitive $30,000. Assuming no issues and a good deal of luck, there is still some debate about whether a successful electric vehicle business will do much to save the sinking ship that is Evergrande. For example, Eric Han, a senior manager with a Shanghai-based business advisory firm, speaking to Hong Kong media yesterday, expressed, quote, "If the vehicles sell well, it will be a ray of hope for Evergrande after months of efforts to keep its businesses afloat. It was an important step taken by Evergrande to wade through its funding crisis." End quote. Others, including yours truly, are more skeptical. Now let's continue with the Chinese property sector. Chinese property developer Guangzhou R&F was downgraded to restricted default by Fitch. According to the ratings agency, the downgrade was due to Guangzhou R&F buying back just 16% of a $725 million bond originally due on Thursday. More pressure has been placed on developer Logan Group Co., with accusations that it has private debt, something the company has come out and denied as a quote-unquote total rumor. The discovery of private debt could hit investor confidence and further hurt the company's liquidity situation. According to a Bloomberg index of Chinese junk dollar bonds, Chinese property developers continue to see price drops for bonds, evidence of a very pessimistic market indeed. Quote, "Chinese developers' junk-rated dollar bonds fell further, putting the high-yield market on pace for its biggest decline in the last 2 months. Prices fell for a 9th straight day on Thursday, putting the week's drop at 3.9 cents. End quote. The same publication, Bloomberg, wrote in a separate article that state-owned China developers are also falling as banks curb loans to local government financing vehicles. Quote, "Shares of state-owned Chinese real estate developers dropped after several of the country's largest banks were said to have become more selective about funding real estate projects by local government financing vehicles. The CSI 300 real estate index slid as much as 3.5%. And we have some more data from the last 24 hours. The modest regulatory easing that we saw on property developers in December, as well as financial stimulus, may be stabilizing demand for real estate. for now at least. This data indicates that average new home prices in China's 70 major cities declined 0.2% in December from a month earlier, slower than the 0.3% drop that we observed in November. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.